Hello and welcome to Energy Insights, your source for the latest data-driven analysis of the global energy markets. In today's analysis, we break down how geopolitical tensions are reshaping the global energy landscape, driving extreme volatility in the oil markets, creating trading windfalls for the major energy companies, and triggering a critical jet fuel shortage across Europe. We also analyze how crude, refined products, and the natural gas, including LNG markets, are diverging in the real time. So, overall, we will cover under today's title the global energy market disruption, Iran conflict drives oil trading windfall, Europe faces jet fuel shortages, and prices diverging across energy benchmarks. So we will cover all these under three different segments. So starting from our segment one, let's dive into segment one, which is the war-driven supply shock and the trading windfalls for the British Petroleum and TotalEnergies. The ongoing geopolitical escalation involving Iran has pushed global oil markets into a highly volatile and structurally disrupted state. This is no longer a typical price cycle driven by supply demand fundamentals. Instead, it is a crisis driven market where uncertainty, supply constraints, and price swings are creating extraordinary opportunities for the companies with strong trading capabilities. Two major beneficiaries of this environment are the British Petroleum and the TotalEnergies, both of which have reported exceptionally strong trading performance during this period. To understand this, it is important to look at what is happening in the physical oil market. The Iran conflict has disrupted flows through the Strait of Hormuz, one of the most critical oil transit routes in the world. A significant portion of the global crude exports passes through this narrow corridor. When supply through such a key choke point is constrained, the immediate impact is tightening of the global oil availability. This pushes prices higher and, more importantly, creating sharp differences in the price across regions and time frames. These price differences, known as arbitrage opportunities, are where trading division step in. Unlike upstream operations, which focus on production oil, or downstream refining, which depends on the stable margins, trading arms thrive on volatility. They buy, sell, store, and hedge oil and refined products across the global markets. Capitalizing on the price mismatches in a stable market, these opportunities are limited, but in a disrupted, war-driven market, they expand significantly. This is exactly what we are seeing now. British Petroleum has flagged exceptional oil trading performance, indicating that its trading desks are generating unusually high profits by navigating these volatile conditions. Similarly, TotalEnergies has reported a strong surge in the exceptional period of the first quarter profits, driven not only by the higher oil prices but also by robust trading activity. What makes this particularly important is that both the companies are integrated energy majors. This means they operate across the entire value chain: production, refining, and trading. During normal times, production volumes and refining margins are the primary drivers of the earning. However, in crisis conditions like the current one, the balance shifts. Even if production is disrupted or cost increases, our trading divisions can more than compensate by exploiting volatility. For example, when the crude supply is disrupted in one region, prices there may further rise and faster than in any other region. Traders can redirect cargoes using storage strategically or hedge positions in future markets to capture profits from these differences. Similarly, rapid price swings allow trading desks to profit from the short-term movements in the oil, diesel, gasoline, and other products. However, this windfall comes with a strong set of challenges. Higher prices and increased trading activity require more capital. Companies need to finance larger inventories and meet higher margin requirements in the financial market. This is why firms like the British Petroleum have also indicated rising net debt level, because operating in a high volatile environment ties up more working capital. From a broader perspective, this situation highlights a major shift in how value is created in the energy sector. The oil market is no longer just about products producing and selling barrel. It is increasingly about the managing risks, navigating uncertainty, and leveraging market intelligence. Geopolitical events like the Iran conflict are turning volatility into a key profit driver. In simple terms, while the war is disrupting physical oil supply and creating challenges for the global economy, it's simultaneously generating a significant financial opportunities for companies with advanced trading capabilities. The stronger performance of the British Petroleum and TotalEnergies clearly illustrate this new reality. We are in times of crisis. The ability to trade smartly can be just as valuable as the ability to produce oil. So that concludes our session one. And now let's move into the segment two, which is the Europe jet fuel crisis and the breakdown of the aviation energy chain. Europe is now facing one of the most immediate and visible consequences of the ongoing Middle East conflict, a rapid escalating jet fuel crisis that threatens to disrupt the entire aviation sector. According to International Energy Agency, the region has only about 6 weeks of jet fuel supply remaining, signaling a transition from the market stress to potentially operational emergency. At the heart of this crisis is the disruption of the oil flows through the Strait of Hormuz, a critical global energy choke point. The conflict has effectively constrained the movement of crude and refined products from the Middle East, which Europe heavily depends on, particularly for the middle distillates like the jet fuel. As a result, supply chains that once operated smoothly are now fractured, with delayed shipments and tightening inventories across the European hubs. What makes this situation particularly critical is the time lag effect. Initially, Europe continued receiving cargoes that had already been shipped before the escalation. However, those buffers are now being exhausted, pushing the system into what can be described as an active shortage phase. This is why IEA warning is so significant. It reflects not just a risk but a rapidly approaching supply cliff. The impact is already being felt across the aviation sector. Airlines are beginning to cut flights and adjust operations not only due to concerns about the physical fuel availability but also because of sharply rising jet fuel prices. Major carriers are reducing capacity, grounding aircrafts, and revising schedules to manage both the cost pressures and supply uncertainty. From market perspective, jet fuel sits within the middle distillate segment, which is structurally more vulnerable during crisis. Refiners often shift yield toward diesel, given its economic and strategic importance, thereby tightening jet fuel output can even further, combined with the logistic disruption and limited alternative supply routes. This creates a refined product squeeze, where shortage in products become more acute than in crude itself. Another critical vulnerability lies in the low storage buffer for jet fuel. Unlike the crude oil, which benefits from the strategic reserves, jet fuel inventories are typically maintained on a short cycle basis. This means that any sustained disruption quickly translates into a real world shortages, leaving airlines with limited ability to absorb shocks. The broader implication is that the crisis is no longer confined to the energy sector, it is spilling over into a transportation, trade, and economic activity. The IEA has warned that if the supply disruption persists, flights cancellation will become unavoidable, marking a shift from the economic strain to a supply disruption. In essence, Europe's jet fuel shortages highlights a critical structural lesson. Energy security is not just about crude availability, but about refining capacity, product prioritization, and resilient logistics. Even if the crude supply stabilizes in the coming weeks, downstream bottlenecks, especially in the aviation fuels, may persist longer, prolonging the crisis. The situation reinforces a key transformation in the global energy markets. Disruptions now propagate rapidly across the entire value chain. What began as a geopolitical shock in the upstream supply quickly evolves into a sector specific crisis where aviation becomes the first and most visible casualty of a much deeper systematic imbalance. From the segment 2, now let's dive into segment 3, which is the market analysis and benchmark trends and the cross market signals overview. This would be our segment 3 for today's episode. So, the last market data reflects a volatile yet structurally divergent energy market where different segments are reacting unevenly to the ongoing geopolitical disruption. Starting with the crude oil, the major global benchmarks are all trading upward but with varying intensity. The American benchmark WTI West Texas crude is trading at $93.26, which showed an upward movement 2.16%. Similarly, the European benchmark Brent crude has risen more sharply to $97.96 with an upward movement of 3.19% in comparison of the last day price, indicated stronger pricing pressures in international markets, particularly in Europe. Meanwhile, the Murban crude stands at $101.18, showed also an upward movement of 0.33%. Holding above $100 per barrel, which reflects sustained tightness in the Middle Eastern supply. In contrast, OPEC basket has declined to $104.56 per barrel, which a negative movement on the downside 4.85%, highlighting a critical divergence. While real-time benchmarks like the WTI Brent are reacting immediately to supply disruption, OPEC basket, being based on the mix of the crude with pricing lags, is still adjusting downward. This mismatch clearly indicates the timing gaps in the price discovery. We are creating arbitrage opportunities in the market. Moving to refined products, both the key indicators are trending upward, signaling tightening downstream condition. Gasoline is at $3.12 per gallon with an upward movement 1.83%. Similarly, diesel, represented by the heating oil, has surged to $3.87, an upward movement 3.08%. The stronger increase in the diesel compared to a gasoline is particularly important. It reflects growing stress in the middle distillates, which aligns with emerging jet fuel shortage in Europe. This suggests that refining systems are under pressure and product markets are tightening faster than crude. In the natural gas, the Henry Hub trading at $2.65 per MMBTU, showing a modest gains. This indicates relatively stable fundamental in the US gas market, where domestic dynamics continues to dominate pricing. However, the LNG market tells a different story. The JKM benchmark traded at $19.20 with a downward movement 0.79%. Similarly, the Dutch TTF has dropped more significantly to $14.34 with a down movement 4.6%. This decline suggested that unlike oil, gas and LNG markets are currently driven more by the regional demand, storage levels, and seasonal factor rather than immediate geopolitical shocks. It also indicates that Europe may still be managing gas supply relatively well even as oil and refined products market tighten. Putting all segments together, a clear pattern emerges. The crude oil markets are reacting sharply upward due to supply disruption and geopolitical risks. Refined products, especially diesel, are tightening faster, reflecting downstream stress and supply chain bottlenecks. Natural gas and LNG markets remain relatively softer, driven more by the regional fundamental and global shocks. In essence, the energy market today is not moving as a single unified system. Instead, it is increasingly fragmented, with each segment responding differently to the same geopolitical event. This divergence is a key indicator of market stress and also a major source of opportunity for trading driven players operating across the full energy value chain. This concludes our today's analysis on energy insights. The key takeaway is clear. Global energy markets are no longer moving in a synchronized way. Instead, they are becoming increasingly fragmented, where geopolitical shocks are driven trading gains, supply chains are tightening in refined products, and price signals are diverging across regional fuels. So stay tuned with the Energy Insights for continued energy analysis and the global energy markets information and price movements shaping the future of the world. Thank you for watching Energy Insights.